expected, lower than expected inflation print. Then you have Charlie Evans coming out of the Chicago Fed and being like, hey guys, it's still a hot inflation print. We're going to keep raising rates.
And I would guess we'll hear more of that from these speeches from Fed officials. They want to see financial conditions sort of sober up a little bit, tighten up a little bit. A day like this is not exactly what they want to see. Like I said, oil was down today. It turned right around after the inflation print. Kind of ironic, but a low inflation print got the risk appetites going and got oil up. So the Fed is definitely going to want to talk this down a little bit.
Yeah, I think equity investors, fingers crossed that maybe the Fed won't be as aggressive as we've seen in the past. All right, right now, let's get back to world and national news. Nancy Lyons in our DC newsroom. Hi, Nance.
Hi, Carol. President Biden is calling the bipartisan PACT Act that expands health care benefits for veterans harmed by toxic burn pits one of the most significant laws the nation has ever passed. He signed it into law today.
This new law matters. It matters a lot. It matters a great deal because these conditions have already taken such a toll on so many veterans and their families.
Biden believes his own son's cancer was a result of his exposure to toxic burn pits while he served in the military. Former President Trump is refusing to answer any questions in an investigation by New York's Attorney General into his business dealings. Shortly after arriving for today's deposition, Trump put out a statement saying he was asserting his Fifth Amendment right not to answer questions. Former federal prosecutor and Loyola law professor Laurie Levinson calls that a bad look.
When the former president is asked to answer questions under oath about his finances, and all he can say is, I refuse to answer because I might incriminate myself, I think that will have a message for the public.
Loyola law professor Laurie Levinson. Donald Trump's 2016 presidential campaign has released former staffers from key sections of a non-disclosure agreement, freeing them up to talk about their experience, good or bad. The move was disclosed in a court filing this week as Trump campaign lawyers angle to end a 2020 lawsuit challenging parts of the NDAs that barred former staffers from disparaging Trump and his campaign and sharing other information about their work. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. I'm Carol Masser, along with Mike Regan here in our Interactive Brokers studio. Mike in for Tim Stanovic on this Wednesday. So this Bloomberg News story by Joe Constance has a great headline on it. No one wants to work is a complaint as old as work itself. As staffing shortages show no signs of abating, employers may want to rethink their approach.
Yeah, I know I don't want to work, Carol. I can sympathize. But it's nice to work with you, though. At least.
Hope your boss is. Likewise.
It doesn't
Do you
feel
really
like
not want to work?
Huh? Well, I'm getting to the age where that retirement is coming into focus.
You have a couple of kids to put through college.
Got to get those kids through college first, though. But yeah, it is a fascinating story and a fascinating phenomenon when you look at sort of the labor market participation rate and the all these job openings out there. And I don't think economists. I mean, certainly demographics play a part of it, but I don't think any economist really has a satisfying explanation for it all so far.
Well, what's interesting about this story is it starts with a quote, and this is the quote: "It's become apparent nobody wants to work in these hard times." What's funny is it could apply to a ton of stories that would be on the Bloomberg right now, or pick your social media website or your news organization. It could be in a current story. It turns out the quote comes from an editor of the Rooks County Record in Stockton, Kansas, lamenting coal mines shutting down by strikes back in April of 1894. So we're talking over 100 years ago. That's what they said. And here we are again, kind of saying the same thing.
Yeah. Well, when it comes to working in a coal mine, I will say I certainly don't want to do that work. I can sympathize with that.
But yeah, exactly. And I do wonder, I know anecdotally, whether it's family members or people I know who are maybe near retirement age or who were thinking about doing something and just said during the pandemic, I'm done. I can retire. Why wouldn't I?
Yeah, there's a political scientist, Paul Ferry, quoted saying, it's a conversation about work, about COVID and inflation. I think the whole COVID lockdown thing really made us all sort of take stock of our lives in a different way.
And look for more balance, no doubt about it. All right, we have more to come right here on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are looking at a risk-on Wednesday, a CPI Wednesday with the Dow, the S&P, and NASDAQ all rallying. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
Good afternoon, Charlie. Stocks are surging after U.S. inflation was cooler than expected. The Dow is up 425 points, S&P higher by 75, with the NASDAQ gaining 320 points. The U.S. 10-year yield is at 2.78%, and small caps are up 25 points. All 11 main S&P sectors are trading higher, led by gains in materials and consumer discretionary, while utilities and energy are lagging. NASDAQ biotechs rise 70 points, transports jump 450, semis rally 105 points, while the VIX is below 20 for the first time since April. Leaders in the Dow, Disney, Salesforce, and Dow Inc., while Merck, United Health, and Walmart are the worst performers. Leisure stocks are among the S&P 500's best performers today, with cruise liners Norwegian, Carnival, and Royal Caribbean each rallying more than 10%. And after earnings, Wendy's fell as sales and margins missed estimates. Alcon dropped 5% after cutting full-year sales guidance, while the trade desk surged the most in 4 years after earnings beats. Wrapping things up, look for earnings from Disney and Bumble after the bell. Live from the First Word breaking news desk, I'm Bailey Lipschultz. Charlie?
And we thank you very much, Bailey. And to hear live breaking news over your Bloomberg, type Squawk, SQUAWK, on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, you are listening and watching Bloomberg Business Week on this Wednesday, and we've been watching shares of H&R Block hitting a record high, the stock nearly doubling this year alone. This is the company reported fourth quarter adjusted EPS that beat. Revenue was flat, raised guidance, though, for fiscal 2023 adjusted EPS, and it did approve a new buyback of $1.25 billion. Really great to have back on Bloomberg Business Week once again Jeff Jones. He is president and CEO at H&R Block. We'd like to remind everybody that Jeff has had a really cool career, including chief marketing officer at Gap, Target, president of ride sharing at Uber. So really in tune with what's going on in terms of the corporate world. Jeff joins us via Zoom from Kansas City, Missouri. Jeff, so nice to have you here. How are you?
I'm doing great, Carol. Good afternoon. And hey, Mike, how are you guys?
Hi, Jeff. Yeah, I did a double take looking at your stock chart today. I was like, Jeff's got to be the one guy. We've been talking about this bear market all year. Jeff's got to be like, what bear market? What are you talking about?
You know what? It's really amazing to see the market starting to hear our story. And you commented on it, Carol. We had a great year. We also provided really strong outlook. And so I think it's a really great combination for the company right now.
Well, and you have been, you've had a 5-year plan. You've been really, working on small business, financial products, a lot of different things. Tell us about the quarter and the look ahead. What's really driving momentum right now, Jeff?
Well, let's start with, our bread and butter, the core consumer tax business. We continue to make improvements in revenue, in client volume, in market share in our assisted business, really demonstrating just how strong that industry is. We talked about going into the pandemic in 19, coming out in 22, up in revenue, up in market share, up in earnings, reducing shares outstanding. So the core consumer tax business has been very strong. We had a record year in small business. And so that means more and more small business owners are recognizing our expertise in turning to us for tax. And then we had a really successful initial launch of Spruce, which is our new challenger bank.
Jeff, the big news in politics this week, obviously, is that Inflation Reduction Act. And part of that is they want to add, I forget how many thousands and thousands of IRS agents. I've got to think that's a very big opportunity for you, but also potentially a challenge. I'm just curious how you're thinking about the ramp up of the IRS enforcement that is embedded in this bill.
Well, we've been very vocal in support of the IRS receiving more funding. They touch more American consumers than any other agency, and they have not had the resources to be equipped to do that. So we absolutely support that. And what we've seen, I guess, over history is when the IRS steps up enforcement, the consumer looks for expertise more and more. Keep in mind the stakes for our clients are very high. Getting this right matters. Getting every dollar they deserve matters, whether you're a small business owner, a gig worker, or a consumer. And so, we're glad they're getting more support, and we're here to help the customer.
You did talk, Jeff, that, your core business is the tax services, but you are expanding in small business. You mentioned Spruce, your mobile banking. What kind of growth are we seeing on those platforms? And do you anticipate that there is a time where they are as equally as important as your core tax business?
Well, there's no question they're strategically as important today. Of course, their earlier stage, we've been in the tax business for decades.
Mm-hmm.
In small business, we had a record year. We grew that business clients 5% on top of 4% last year, and believe there's still lots of upside in serving small businesses. Just looking at the landscape, those people that have side hustles, 1099s, gig workers, they may not consider themselves to be a small business owner, but they absolutely have tax and bookkeeping, potentially payroll needs, just like a small business would. And then with Spruce, we had a fantastic launch. That product has been in the market only a handful of months. We've had 7 major releases of the app since we launched. And right now, the team is focused on testing customer acquisition outside of tax season, and then getting ready to launch it in our retail channel next tax season. Obviously, we have a very large install base of customers, and we want to take full advantage of introducing them to Spruce next year.
Jeff, what's cool about talking to you, you talk about small business. It's funny, our colleague on television, Caroline Hyde, she talked about the small cap, the Russell doing really well and outperforming the broader market. And a lot of that has to play with kind of domestic businesses here in the U.S., maybe upbeat about the outlook in the economy. So I love hearing what you have to say about small business. I love hearing about Spruce because you get some insight into consumers and really kind of maybe how much money they've been able to save and so on and so forth. Based on what you are seeing, based on your business overall, would you say, yep, we are headed for a recession in the next year, or we're not?
If I just had to simply call it, I would say we're not. But like you all do as well, we're looking at the same data. There are days to be optimistic, and then the next day you need to be cautious.
Mm-hmm.
Something that we did, and we'll be releasing this very soon, is for the second year, we're going to be publishing what we call the Outlook on American Life. And so we aggregate all of the data from all of our clients' tax returns to find the themes and trends. And, that tax return is really like financial DNA. And so we'll be talking about what we're seeing with shifts in employment, retirement, savings, spending, and look forward to maybe sharing that with you all when we're ready to release it.
Look forward to it.
Absolutely.
So in terms of, okay, so we're going to look forward to that. You say not a recession based on this. So you said, listen, investors are certainly plowing into your stock. You seem very optimistic. What is it that maybe troubles you a little bit? Is there some concern about the Fed overdoing it and putting some slow momentum ultimately into the economy?
Yeah, obviously, part of our diversification is to participate in different parts of the market. In the tax business, that business over many, many decades has not been sensitive to recession,
right,
because of the obligation we have as American filers. In fact, when economic times get tough, the stakes rise. That's when our expertise and value really kick in. So obviously we have to execute and continue to build on the momentum we have, but that business looks different than, for example, in our financial products portfolio where, if savings rates are lower and maybe credit is starting to rise again and every dollar matters and government subsidies are gone, then what we have to do with Spruce is make sure people know that product is a almost completely fee-free product that offers incredible value to help you spend and save and plan. And so we try to lean into how our value proposition is helping consumers because we know that every dollar really matters.
Jeff, there's always a debate when a company has a lot of cash on hand, whether to issue a dividend, increase that dividend, or to buy back shares, what the best avenue is to return that cash to shareholders. You guys doing a little bit of both, increasing the dividend 7%, also a new share repurchase authorization, $1.25 billion. How do you think about how to return that that capital to shareholders? Is it best to do a little bit of each, like you're doing, or what's the calculus that goes into deciding how to do that?
Well, Mike, I guess I'd also say the first part is investing in our business,
right?
Which we are absolutely doing. Now, we're able to still generate significant free cash flow to invest in dividends and share repurchase because of our expense management discipline, where we're essentially self-funding our growth to create new products like Spruce and to invest in Wave and other things. So once we make those decisions to invest in the business, then we're essentially returning the remaining free cash flow to investors. We're committed to our dividend. We've been growing the dividend. And if you think about on a given year, roughly a couple $100 million to continue to invest in our dividend, and the rest, $200 to $300 million, is in share buybacks. So because of the profitability of this business, I think we're in a unique position to be able to really do all three at an effective way.
Jeff, it's an interesting story in terms of what you guys are doing. We have about a minute left here. As you guys have been broadening out, expanding services, I mean, part of it is so that you can kind of, not see so much of kind of positive results or so much business momentum kind of during tax season, right? So are you seeing signs of it, that there's more business throughout the year?
Yes, but we're not even close to being down the road of that journey yet. So, again, the lion's share of our business today still happens in tax season. As we serve more small businesses, those dates extend. Bookkeeping and payroll becomes year-round. Mm-hmm. And clearly the goal for Spruce is to be a year-round financial products business. We're just in the early innings, but that's absolutely the strategy.
All right, got to be really quick, 30 seconds. We like to do this when we've got a leader of a company so well known. What keeps you up at night?
Continuing to meet expectations and all the growth we've been delivering. Okay. That's what we're up to right now.
Yeah, and the expectations are pretty high. I mean, as we said, the stock is up 93% here in 2022. Jeff, always appreciate time with you, and interesting to hear how the story at H&R Block really continues to evolve. Thank you so much. Really appreciate it.
As well. Bye-bye.
Be well. Jeff Jones, he is President and Chief Executive Officer of H&R Block, joining us via Zoom from Kansas City, Missouri. As we mentioned, the stock really on a tear today following those earnings. Stock, Mike, up more than 15% in today's trade, and again, up 92% so far in 2022.
Yeah, picked a good day to report some good earnings.
Yeah, exactly.
Everyone's ready to buy.
Exactly. Really some outperformance. All right, back to the overall market trade, back to Charlie Pellet.
Hey, thank you very much. And here's what's going on, Carol Master. We've got the Dow, the S&P and NASDAQ all advancing. 30 minutes to go ahead of the closing bell. Right to the numbers. We'll give you the why. It's a CPI Wednesday here, and a good one of that. S&P up 80 points right now, a gain there of 1.9%. The Dow up 455, up 1.4%. NASDAQ up 339, up by 2.7%. The NASDAQ 100 index up 2.6%, and the Russell 2000 is surging now by 2.9%. 10-year yield 2.78%, the 2-year yield 3.22%. Spot gold down $4 the ounce to $17.89, a drop there of 0.3%. West Texas Intermediate crude up 1.3%, 91.66 a barrel on WTI. Risk on, S&P on track for its highest close since May. Stocks are surging, the dollar is sinking. Softer than expected inflation data is fueling bets the Federal Reserve could pivot to a smaller pace of hikes. The Walt Disney Company will be reporting in roughly 30 minutes. Disney shares up now by about 3.8%. There will be a focus on growth in streaming subscribers. Heath Ranganathan is a media analyst with Bloomberg Intelligence.
So when they report tonight, the magic number that we're looking for is about 10 million subscriber gains. But I think what really people are trying to assess is whether they are going to actually reaffirm their guidance. And their guidance is for about 250 million Disney Plus subscribers by 2024.
And again, we do have shares of the Walt Disney Company advancing now by 3.75%. Also reporting after the bell will be Bumble. Again, recapping, stocks higher. S&P up now by 80 points, a gain there of 2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar and Mike Regan here in our Interactive Brokers studio at Bloomberg headquarters. So another one of our most read on the Bloomberg today has to do with Elon Musk offloading yet another chunk of Tesla shares. shares. It's a pretty big chunk. This is to gather up some cash in case he has to go through with buying Twitter. Tesla shares are up, so too are Twitter, but I should point out that it's in an overall risk-on trade that we are seeing these shares go higher. Let's get to it with Bloomberg News West Coast correspondent Ed Ludlow. He is in our San Francisco bureau. Ed, nice to be talking with you. So I feel like we always have to talk about a little Elon Musk every day. What is he up to?
Yeah, I mean, he tweeted after the regulatory filings hit that there's kind of two rationales here. One, if the court or the judge in October, reminder the trial starts October 17th, enforces the original terms of the deal, he didn't want to have a fire sale, as he puts it, right? Like, he doesn't want to sell Tesla stock right at the last minute in reaction to that and cause a disruption in the market. But the other side is that, you know, October 17th is still quite far away, and if the judge does enforce the deal, the equity financing or equity partners he's lined up in advance could walk away or not go through with their commitments. And so he wants to have the available capital in the event that that happens.
You know, it said even, it's interesting, even in his statement about this, he said in the parentheses, hopefully unlikely event that Twitter forces this deal to close.
Right.
I can't help but wondering what happens if that does occur and he suddenly finds himself as the owner of Twitter. Do you think he'll actually just hold on to it, or is there any sense that he'll try to flip it to someone else eventually?
Well, who knows when it comes to Elon Musk, Who knows? I mean, the market disagrees with him, right? That not just the basics of the spread tightening, the current share price versus the offer price of $54.20 a share. I think most merger arbitrage specialists that Bloomberg have spoken to this morning would say that this raising of capital by selling Tesla stock moves us in a direction towards a settlement, either out of court or in court at terms that both sides find acceptable. But in any case, we're moving towards a place, to answer your question, where he buys it. You know, I think back to last week in Tesla's AGM, he kind of was indirectly asked about this, and he said he understands the product pretty well. He feels like he could push Twitter's engineering in a direction where it would be improved. And those sound like comments to someone that's expecting for the deal to happen.
Well, I was going to say, I love the quote in one of these stories by a member of our Bloomberg News team. I mean, he talked to somebody who said he's cashing up for Twitter. I mean, he unloaded $7 billion of Tesla shares, $32 billion since November, and that's a ton.
Yeah, it is, and it's somebody that's historically not sold that volume of Tesla shares to raise that amount of money. Remember, Elon Musk's always kind of maintained that he doesn't take a salary from Tesla. His compensation is almost 100% stock-based, and he's only ever sold the stock to cover his tax obligations. So this is a meaningful amount of money. He also said, by the way, and we should be fair, that if the Twitter deal does not go through, he would come back into the open market and buy more Tesla shares. You know, he's in it for the long haul. Last week at the AGM, he says he has no plans to go anywhere.
So wait, this is the man who said he was going to buy Twitter? We can trust what he said? You know what I'm saying.
True. Well, all I'll say is that he often overpromises, underdelivers. He often does do what he says he'll do, just not on the timeline originally outlined.
That's very fair. That's very fair.
Carol, I feel like I wish we could bring Jeff from H&R Block back to figure out what his tax bill would be on this.
That's a really good point.
The stake share. I wonder what the capital gains on is that. But Ed, do you trust that this is all the shares he'll have to sell? I mean, is there a chance he could have to go back to the market again and raise some more cash?
You know, I think we have to remember the current structure of this deal. $54.20 a share is the offer price. Musk had lined up debt financing through some of the creme de la creme of Wall Street banks. He removed the margin loan component and increased the equity financing component with well-known associates of his, big names from across Silicon Valley. Binance got involved. Other high net worth individuals made pledges. So it seems like the components are there. Again, all we go off is what he tweeted. And one of the possible things he's concerned about is that come October, if a judge forces the deals go through, those fair weather equity partners are no longer there, right? And he's left having to, carry the check for the entire amount. But $32 billion is a big chunk of the $44 billion that $54.20 a share would value Twitter at.
You know, it's interesting, right, Ed? I think about this whole process when he came out and announced the deal and just the ups and downs of maybe going through, maybe not, and here we are facing a court case. But it is interesting too financially, right? Like we talked for so long about his exposure, and then he lined up people to kind of help him with this. But I do think about selling this chunk of stock also gives him a little bit of a pad, right? A personal cash pad potentially.
Yeah, and again, he always reminds us on Twitter that he doesn't live a lavish lifestyle, that he has very few material possessions, but he has got other costs that he needs to meet. I think one interesting point as well is we haven't really talked about valuation. Twitter's stock has kind of been immune to the volatility of public markets because it was subject to acquisition. But the fundamentals have changed for all advertising-based social media platforms. And, the other school of thought is that by raising these funds and in a place where we move towards a settlement, we now are back in the territory where a scenario of a lower price point offer comes to the foreground. So that's also interesting. Maybe, he's just making sure he has the capital that values Twitter less than $44 billion. That is a hypothesis some in the market have put forward.
Yeah, and it's been such a soap opera, a financial soap opera, this story. I'm just
being
wondering.
A bit kind, yeah.
What's next? When are we actually going to see the courtroom drama?
Right, so October 17th is the start date. The judge had basically ruled in Twitter's favor to have a trial this year. The Musk team had wanted it to be in February. The middle ground was October. Musk team asked for, later in October. Twitter team asked for earlier in October. And the judge basically said, you guys sort it out yourselves. And October 17th was where we landed. So it's in Delaware court. These courts have a history of moving quickly and unraveling quite complex M&A law. I hope to be there myself. There's nothing I like better than standing outside of a courthouse on the street. And I hear Delaware is lovely in October.
Will he be there?
He has and has not turned up to court cases involving him. It depends. I think of the Solar City one. But yeah, I hope he'll be there, and I'll wave if he is.
All right. Well, we're looking forward to that and anything you do. Ed Ludlow, West Coast correspondent at Bloomberg News in our 960 studio in San Francisco. Back to D.C. we go, and back to Nancy Lyons with World and National News. Hey, Nance.
Thanks, Carol. President Biden says he's hopeful the country is turning a corner on inflation, with today's report on the Consumer Price Index for July showing inflation now at 8.5% from a year ago, down from 9.1% in June. He's also encouraged by the month-to-month inflation numbers.
Well, the price of some things went up last month. The price of other things went down by the same amount. The result, zero inflation last month.
Biden cautioned, though, the nation could face economic headwinds in the coming months due to the war in Ukraine and supply chain disruptions due to pandemic shutdowns in Asia. Biden spoke at an event where he signed a bill into law that gives access to expanded health care benefits to veterans exposed to toxic burn pits. Former President Trump has been sitting for a deposition today in the New York probe into potentially fraudulent asset valuations by his company. In a statement after arriving at the New York Attorney General's office, he said he invoked his Fifth Amendment right against self-incrimination and declined to answer any questions. Greg Farrell with Bloomberg's legal enforcement team says that's not unusual for Trump.
It's very difficult to get him to actually testify under oath to say something. Even in the Mueller investigation, he and his legal team insisted that special counsel Robert Mueller submit questions in writing, and rather than go to war, Mueller accepted that.
Bloomberg's Greg Farrell says it is likely the New York AG will win this civil case, which could prove costly for the Trump organization. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy Lyons, thank you so much. Carol Master along with Mike Regan here in our Interactive Brokers studio, and talking a lot about, obviously, the inflation print today coming in less inflation, so better than expected. And so there's a lot of enthusiasm playing out in the markets. In the meantime, you take a company like Sweetgreen, which is up about 7.5%. We heard Nancy talking about inflation. This company did come out. They did cut their sales outlook, their revenue forecast for the year. It was the latest consumer company to warn about weakening demand, and yet the stock is higher.
Yeah, and
it was down 4% yesterday, but up 7.5% today.
Yeah, it really gives you a sense of that risk appetite in the market out there. But yeah, really, the company's saying both in the Bay Area and the Northeast, some of its real places where it has a lot of business. Workers have been returning to the office, but at a slower clip than some of the other parts of the country. So I guess these big cities, people are still reluctant to get back at the desk and eat those salads.
Aren't you worried? I used to go to Sweet Green a lot. I really don't kind of leave the office once I'm here because it's just busy. Not complaining, just a fact. But I do wonder, I'm curious about once fall hits, Labor Day is over, kids are back in school here, presumably back in a lot of the schools in the city. Are we going to see a lot more business traffic? I don't know.
I would guess that's probably a pretty good prediction. I'm going to hold you to that. I'm going to check back with you.
I'm asking. I don't know, but I'll hold you to that.
I think it makes a lot of sense, though. And I got to say, just the trains. I don't know what your trains are like coming into the work.
Pretty quiet.
Oh, really? Oh, interesting. Mine's been pretty packed.
Yours have been?
Yeah, but then again,
and you're coming from an hour outside the city.
Yeah. So it's. I'm sharing the seat again. So people are slowly but surely coming back. Then again, the trains are running fewer cars, so it's hard to say for sure.
All right, so we mentioned Sweet Green. I just want to squeeze in one more. Wendy's also among those, especially in the restaurant space, the latest restaurant chain to show signs of strain thanks to rising inflation, second quarter sales and restaurant margin falling short of Wall Street projections. I mean, anybody who's dealing with food right now, it's
those
not
input
easy.
Costs are off the charts.
Yeah, it's really tough. All right, Bloomberg Business Week. Carol Massar, Mike Regan. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ 100 index all pushing higher. In fact, right now we are trading at session highs, a rally into the close on track for the highest for the S&P since May. Right now, the S&P 500 index up 88 points. That is a gain of 2.1%. Dow Industrials up 523, up 1.6%. NASDAQ and the NASDAQ 100 index, though, the outperformers right now. We've got the NASDAQ Composite Index up 2.9%, NASDAQ 100 Index up by 2.8%. Russell 2000 up right now by 3%. 10-year yield 2.78% on the CPI Wednesday, and West Texas Intermediate crude up 1.3%, 91.71 a barrel. Spot gold down by about 0.2%. Softer than expected inflation data fueling bets the Federal Reserve could pivot to a smaller pace of hikes. Again, recapping ahead of the close here, S&P best level now up 86 points, a gain of 2.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, appreciate that update. Charlie Pellet there. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Oh, what portents are these, demands a character in Shakespeare's Henry IV. Former President Donald Trump may well be wondering the same after FBI agents searched his home at Mar-a-Lago on Monday. The rest of the country could use some answers, too. This is a fateful moment for U.S. democracy. Whatever happens next and wherever the investigation leads, there can be no unringing this bell. So it's essential that Americans get a sober, transparent explanation for these latest developments. The sheer amount of unpunished wrongdoing that occurred under the Trump administration has many people cheering this extraordinary intervention, but it is nothing to celebrate. Trump himself has tested the American system in ways unseen since the 19th century. It is critical that the pursuit of justice does not merely compound the damage. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, folks, just about 10 and a half minutes left in today's trading session. Let's not forget, too, we've got a big earnings report coming out after the closing bell, just a few minutes after the close. We're talking about Disney, so we'll be looking certainly at their streaming services and a lot more and all their moving parts, what it says about the consumer. We'll break it down with our TV colleagues. In the meantime, let's break down, as we move closer to that closing bell, Alan Lance is back with us. He's Director of Research at LanceGlobal.com, President of Allen B. Lance & Associates. He joins us once again on the phone from Toledo, Ohio. Alan, you're here with myself and Mike Regan. Tim is off today. Upbeat day. We're excited about, still a hot inflation print, but not as hot as somebody, as most expected. And we've seen certainly a risk on trade today. How do you see it?
I think what we're seeing, Carol, are extremes, and now I think there might be an overreaction going into, a solid CPI report and interest rates,
Overreaction by equities?
Yeah. Just like in April when we talked and commodities were moving up and everybody was talking, inflation like the 1970s and that you could see that was going to be a peak in commodities and energy and was up 60% as a sector, et cetera. I think, now it's the other end of the spectrum where all of a sudden now one CPI report and now, inflation is calm and taken care of, et cetera. So for some reason, investors, meme stocks are back, and it's just a total exaggeration. Just like in April, that we had inflation like the 70s. Now it's no inflation and an upward market, and I'd be wary. I think there's still pockets to make money, and there's been some good sectors to invest in, and I'm glad we did this summer. But I wouldn't be chasing some of these. And if you're overexposed, like a lot of investors were going into the year, I would be reducing risk. So we're not as negative as we were going into 2022, but the higher prices and values rise here, the more concerned we'd be.
Alan, obviously, such an important story this year, not only for the inflation and economic side of the equation, but market leadership, in fact, has been the oil price rally now coming back to earth. I was reading your latest newsletter. You say, if anyone would have stated 10 years prior that in 2021 we would start to make energy our most emphasized sector, we would have responded, not very likely. I think you're probably not alone in those sentiments, but how are you thinking about oil, gasoline, energy stocks now going forward, that it does seem, knock on wood, that these aggressive price gains in gasoline and oil, at least for the moment, seem to have come back to earth?
Yeah, I think that could be an opportunity. So just like we were talking earlier, might be an opportunity to reduce risk, or take some profits in some of these, stocks that have done so well. Energy gets hit, further here. I think over the long term, there's some select, opportunities there, and we'd be buyers just like we were the past, 2 years into weakness. So that's the nice thing about this market. It is giving you, a disciplined investor a chance to, take advantage of these swings. It's just a matter of the swings are so much more extreme than, we ever anticipated. And some of that, is the Russia-Ukraine, situation, et cetera. Everything's gotten accelerated, and the supply, side shortage and items like that. So that's why, 1970 type inflation, that was, built into the cards in April, didn't make sense either, because we knew some of those were temporary. But I think eventually reality will set in back in the market, and you'll see that inflation's not gone forever, and interest rates are still going to go up, and the market will react, and energy will again move up. So any weakness into energy, quality energy with the income and with their current valuations, I think it would be a smart move.
I also noticed you're liking Goldman Sachs stock these days. What's the story there? What's got you attracted to Goldman?
That's funny. We bought it in November 2009. In the midst of the global financial crisis, and we just said, anytime you can get Goldman under book,
right.
It's a smart move. And this summer it was trading under book again. And I think for investors that sometimes you get out of the market and you don't get back in, you get worried, and then it's difficult. So you got to use these disciplined strategies. So when you get this high quality, good income producers that are cheap, take advantage and buy them. And I think that's what we're seeing. I think the financials are an area that will do well, and some areas like H&R Block, that we've owned for years, we'd be more inclined to take profits into the spike. Stocks almost doubled this year in a bad market. And
well, it's so funny that you say that. We just talked with Jeff Jones, the CEO of H&R Block, and that's one of the things we talked about, the stock doubling. Would you just take profit because, man, what a run, why not? Or is it something more fundamental, or do you believe fundamentally in the H&R Block story?
Oh, I think it's it's an interesting story, but just valuation-wise, Carol, we're just going to be disciplined. I'd rather have my money in Goldman, at or below book than H&R Block at this stage. And the things that were attracted to us when we first bought it at half the price was, the income stream, and that it was unrecognized on Wall Street. While now, the cat's out of the bag, and the company's doing well, and they did, get into other services that provided high margins. So everything fell into place. So partial profit profit taking at least, makes a lot of sense. And for investors that are, more concerned about risk, we're taking full profits just from the standpoint that, there's definitely a lot more risk in execution now than there was, when the stock was half the price.
Well, always, as we say, we really love checking in with you. So thank you so much. Alan Lance, he is Director of Research at lanceglobal.com, President of Allen B. Lance and Associates, once again on the phone from Toledo, Ohio. We've got just a little bit more than 3 minutes left in today's trading session. Stocks pretty much near their highs of the session, especially when it comes to the technology trade. That NASDAQ up more than 2%, almost 3% as we speak. All right, time to head over to our TV colleagues who are cross-platform coverage. We call it Beyond the Bell on radio, TV, and YouTube. We are counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Katie Greifeld, counting you down to the closing bell, held to take us beyond that bell. As we do day in, day out, a global simulcast for you. Carol Massa and Mike Regan's in for Tim Stenovic, bringing together our Bloomberg TV, radio, and YouTube audiences to celebrate a bull market. Is that what it is, Carol?
I would not necessarily say that. I don't know. It definitely, technically. All I would say is that the one thing we can count on this year is volatility. We bounce around on a daily basis, on a monthly basis. But yeah, there's definitely a risk on trade in today's session, Caroline.
Risk on trade, Mike. I mean, I think we are about 20% higher on the NASDAQ, I think it is, from our lows. But it doesn't feel like that still. It still feels like this is a pain trade in some way. Many still calling, of course, a bear market rally, dare we say.
Yeah, and it's just been such a volatile year. I remember not too long ago we were talking about how more than half of the days this year have seen a move of 1% or more in that single day session. So we kind of had come back to earth, had some quieter days in the market there for about a week or so. But it's hard to trust anything this year when we have had so many up and down days like this that we've seen already, Taylor.
I think Carol Schleif over at BMO Family Office sort of put it best, that she still thinks that we're range-bound. Maybe today, of course, hinting up near the upper range of that range-bound area. But it's the path from 8.5% to closer to 2% that really catches her attention when you're thinking about, okay, we're coming down, but we still have a little bit of a ways to go. And what does that path look like, and how volatile is that path?
Is it a path, or is it sort of a road? To Carol's point, that is a long distance to travel, and that's why she's speculated, or rather sort of hesitant on some of those high growth areas of the market.
Meanwhile, the high growth areas of the market did pretty well on the day, and as the bells close, as people clap, the confetti, it comes down. We look at a NASDAQ that's having its best day since July 27th, 2022. So not all that long, but still we managed to rally up almost 3%. And we're now at a highest since we've been on the level since May the 4th. We're currently up 360 points, 2.9%, let's call it, on the NASDAQ. The S&P also up more than 2 percentage points, 87 points higher, 4,210. We're seeing a good day for the Dow as well. Most of the members there up, and we see it 1.6% higher. And we dial out to see really small caps crushing it. The S&P, we see the Russell 2000 up almost 3% on the day in terms of its day of trade, Carol.
Yeah, and including the Dow component, you said you're talking about the Dow in terms of the performance. One of those Dow components, Disney, up almost 4%. They're going to be reporting earnings any moment from now. And I am thinking about things like Thor: Love and Thunder, just crossing 700 million in worldwide ticket sales. What will that mean for that company, guys?
We'll go from some of the micro back out to the big picture look. Carol, as we firmly hold 4,200, I think it's always, how do we continue to hold 4,200 if that really is sort of a bullish level? Underneath the surface, the technicals look pretty good, though, in terms of holding that bullish sentiment. Chip makers, media, you mentioned Disney, transportation index, firmly all these sectors above 3%. And I have to say, for the radio audience, we always pull up the worst sectors as well. The worst performers are still all green. So that really highlights sort of the broad-based nature of this rally. There's one sector in the red, it's telecommunications, but everything, you're seeing a lot of green here, Carol, under the surface.
Yeah, very easy for me to find a bunch of gainers, and among them, Taiwan Semiconductor. I'm looking at the ADRs. TSM is the ticker here in the United States. That ADR up about 4%. The company overnight, they are the world's largest supplier of made-to-order chips, up, talking about sales climbing nearly 50% in July from a year ago. So some outperformance in a sector, the semi sector, which has really been beaten down over the last 3 days. H&R Block, I know TV talked to the CEO. We just talked to the CEO. That stock up 15% in today's session. This after fourth quarter adjusted EPS from continuing operations beat estimates. They also announced a new buyback of $1.25 billion. So that stock almost doubling in 2022. So there's really been some outperformance in that name. And then I want to mention Norwegian Cruise. That's up about 12%. We did see it selling off yesterday after forecasting a third quarter loss, but maybe some positive news. The company also came out and talked about a jump in immediate bookings right after they announced that the vacation requirement on cruises in terms of, I guess, vaccines and booking, not necessarily important or necessary anymore in any way. That optimism maybe providing investors kind of coming back into the name.
NASDAQ
Carol.
100.
What?
NASDAQ Composite. Close up 20% from their June lows. It's here, people.
It's in red, so
all right,
you
so
know
bull
it's
market,
real.
Bull market is here.
Are we going to say it?
Market while we have it. Who knows if we'll have
Where's
it tomorrow.
the confetti?
You clear your throat.
I need a hat.
Yeah.
I need some animation there, yeah.
Well, I realized as the new guy, I had the assignment of trying to find some decliners today. And I got to say, it was pretty tough. One I want to talk about, though, Merck & Company was down about 1.5%. Got lifted with everything else in this risk-on day today, but it closed down about 0.4%. Januvia, which is a popular diabetes drug from Merck, is actually found to be contaminated with a potential carcinogen. It's interesting. The FDA is actually going to allow this drug to continue to be sold because they don't want to risk a shortage of diabetes drugs, but certainly a story to watch there with Merck & Company. Also on the downside, Constellation Brands, they were down about 1.2%, trim those losses to less than 1%. Interesting story brewing there with them, no pun intended. They are a big brewer and wine and spirits company.
We love a pun on this
Okay, I admit it was intended. But anyway, there's concern that Mexico is going to tell them to stop using the water because the drought condition in the north of the country is so severe. Now, the company is saying that the president of Mexico is allowing them to continue and is okay with their expansion plans. But certainly an issue globally, this drought we've seen to keep an eye on with Constellation Brands and other really water-intensive stocks for the rest of the year until these dry, arid conditions resolve themselves. One other decliner, Ralph Lauren, they were down big yesterday, more than 4%, after saying that foreign exchange headwinds would kind of impact their results going forward. Today was the analyst turns to cut their price targets. 4 analysts changed their price targets. The average was down about 2.9%. So Ralph Lauren down about 1.3% today.
I'm going to interrupt you, Mike. Disney coming out with big third quarter Disney Plus subscribers. 152.1 million. Estimates here were for 148.4 million. They are, though, very interesting, going to be raising the Disney Plus ad-free streaming price by 38%, a sign of some of the inflationary issues underway. So those are sort of the key headline numbers. We'll continue to go through the parks, the experiences, the products. We have the operating income for that, just topping about 2.2 billion. Third quarter Hulu and live TV subscribers come in maybe just right here on the nose. 4 million versus estimates of 4.1, and overall Disney third quarter revenue coming in 21.5 billion versus estimates of 21. Disney third quarter Disney Plus subscribers, as we mentioned, sort of a big beat on the top line, really reaffirming and trickling all the way down to the bottom line, an improvement here on the adjusted EPS. That this is a company with pricing power that continues to show its worth.
And we talk about an ad-free product that's going to be raised by 38%. We're getting an ad-supported version as well of Disney Plus on December the 8th. So in the same way that you have the premium subscriptions on a Spotify, you're going to be getting the same with Disney. And indeed, as we've heard from other companies, the way in which they're partnering up with Microsoft of this world to be able to do that. But we certainly heard that from the Netflix, for example. We're looking really at a company that manages to still fire on all cylinders. This is what the words with Bloomberg Intelligence really was, a company that's able to dine out on the fact that people have all this pent-up demand, the fact that we're seeing parks, experiences, products really coming in strong with an operating income of 2.2 billion, but you're still seeing the media and entertainment managing to knock it out the park overall. The question is, what are they spending on their overall content as well, and how much was perhaps the decision not to do the rights for the IPL, the all-important cricket in India, did that hurt them in any way? But with an addition of 14.4 million Disney Plus subscribers in just their fiscal third quarter, that of course course, does mean that they are adding again and again in terms of their streaming options. And we want to know what the full year guidance is going to be for 2024, Carol.
What's crazy, Caroline, I mean, the stock is up 4% in the after hours, shares of Disney, and we did see them start to trade higher just ahead of the release. But what's wild is this is a company that's showing that the pandemic play, right, streaming, they are really, really strong on that front, but they're also benefiting from the economy, opening up and everybody wanting experiences. So as you said, firing on all cylinders, but I got to say that Disney Plus subscribers, 152.1 million. The estimate was 148.4 million. That is some big outperformance.
Certainly is. We want to be bringing in now some even more intricate detail with Geetha Raghunathan, I'm pleased to say, U.S. media analyst for Bloomberg Intelligence. You previously have said this is a company that's firing on all cylinders, and the subscribers is better than anticipated in terms of the net additions for the third quarter.
Oh, yeah, this is a blowout quarter, Caroline. I mean, we were looking at something like 9.8, 10 million subscriber ads. They come out with 14.4 million. And it's not just the subscriber number. It's all across the businesses, as you just pointed out. You look at that Parks number, we were expecting about 1.7 billion in operating profit. I think it's close to about 2.2 billion. And really, I mean, this was such an important quarter because if you see so far, like streaming has really kind of been this mixed bag. You had Netflix with fairly disappointing results, and it's been a little bit all over the place. Peacock, no growth. HBO Max, again, anemic growth. So for Disney to come out and do this, I mean, there's really so much momentum in their business with all of their content releases, with all of their new market launches. And this really kind of sets them up for an excellent, fiscal 2022.
Is this the appropriate diversification within the business model as well, to be introducing ad-supported versus just subscription only, too?
Oh, absolutely. I think, and they have timed it so perfectly. I mean, we are entering a period when, you have so many of these macro headwinds, you have an inflationary environment, and they're clearly now making that product. Remember, first, they started the Disney Plus product off at a pretty economical price point, which kind of, gave them a lot of room for those price increases. But now as we head into this environment when everybody's kind of tightening their purse strings, just giving people that option of having that ad-supported version at a lower price point really opens up the market for them considerably, and it kind of, will reduce churn as well, especially as kind of people look to pare back on, 4, 5, 6 streaming services. In this kind of an environment.
So there is that lower price ad-supported service, that tier, but I mean, at what point do you start to worry about demand destruction?
So I think for them, what they've already done really, really well, they already have the infrastructure in place as far as the ad-supported product is concerned. And this is a real deviation from Netflix. So they have their product with Hulu, and what we've seen is that the ARPU, the amount that they're generating per user on an advertising-supported product is actually even higher than what they're generating with their ad-free product. So, in terms of demand destruction, I don't really see that happening. This is a product that they have some of the best brands in the world. They have some of the best IP in the world. This is a product that really has a long runway that has a lot of legs.
So, Geetha, what's the smart question on the analyst call here for Disney at this point? Because as you said, firing on all cylinders. I mean, it's really a blockbuster quarter for this company, but they're so reliant on the consumer. It seems like they feel confident enough to raise, prices at this point. So what's the smart question that we ask this company, especially as we still are concerned about maybe a slowing economy? Maybe it's not until next year.
Yeah, that absolutely is going to be the question. I think that everybody is going to pose to them in terms of what they're seeing right now, in terms of pacings, in terms of per capita spending at the parks. But I think more importantly is really that question about the streaming subscriber guidance. Yes, they've had excellent results for this quarter. Yes, we know that momentum will continue. But remember, they are going to lose the rights to the IPL starting next year. So while we might not see any fall off in subscribers this calendar year, there's always that possibility that going forward next year, especially as the rights move to another platform, we might have a little bit of a drop off in subscribers. And remember, when we're talking about their goal of 250 million subscribers, about 80 to 90 million of those are on that Indian Hotstar platform. So cricket is absolutely pivotal for them in order to attract that subscriber base. So we're really going to look for commentary to see, what that subscriber target is going to be.
Geetha, I also wonder about the dividend. Disney was famously a dividend stock for a long time. Any expectations for what we'll hear about their dividend this year?
So they have kind of, they have, ever since their Fox transaction, they actually paused, capital returns, and especially after the pandemic, they really had to kind of preserve liquidity. So we really haven't heard anything from them on that front. So it'll be interesting to see if they kind of reinstate that, and especially buybacks as well.
Really appreciate your instant analysis, and so smart as always. Geetha Ranganathan, U.S. media analyst for Bloomberg Intelligence. And amidst all of the hype, and indeed the hype is well deserved, I think what also really stands out to me, you guys, in the press release under the direct to consumer is continuing to highlight the elevated marketing costs, the elevated content costs as well. They talk about a higher loss at Disney Plus due to some lower operating income at Hulu due to higher programming, higher technology, higher production costs. They talk about that at Hulu. They talk about that at ESPN Plus as well. So the cost of content, at least for now, doesn't look like it's getting any cheaper.
Yeah, and having to make the profitability work on the actual more linear television, the ABC, for example, is because they're dialing back on marketing spend. They're dialing back on some of the cost spend overall because some of the advertising revenue coming in a little bit lighter than had previously been had. But they do mention, of course, the focus on the IPL as well, adding matches to the current season, but all of this is something that we're going to watch from an international basis and from a domestic basis as well. But really, the CEO sounding pretty bullish across the board, it would feel.
Well, and it's interesting, we're talking so much about streaming, and that is certainly seems to be the future of the company, but let's go back to some of those legacy businesses, because Parks, as our live blog is pointing out, Parks really helping drive earnings higher in the quarter, the unit beating revenue estimates by nearly $1 billion. We know it's not inexpensive to go to a Disney park, but vacations are back, families are vacationing, and Disney is definitely benefiting as a result.
Absolutely, and the bar was high there when you think about what we heard from Universal, but of course you have to wonder about how sustainable that demand is. Not to sound too bearish here, but we know that, costs are going higher. People's purses are shrinking. Where do they go? Probably staples. I mean, vacations obviously fall under discretionary spending.
Yeah, and you have to also wonder, is that a sustainable bump in the parks business, or is it just a sort of bottleneck of demand now that people are able to take vacations and get back in those parks again this summer? So something perhaps to hear on the analyst call, see if there's any color on that going forward.
Let's push forward to the analyst call and bring in our very own Lucas Shaw, of course, joining us here. And Lucas, I think we really want to kick off with the streaming service, the Disney Plus, because that's been such a big focus here in the last few years for the company. I wonder, though, if you're concerned that the average monthly revenue for paid subscribers, at least on a domestic basis, is falling. That's being maybe offset by an increase in the international. But are you looking at different profitabilities between a domestic-focused streaming customer versus more of an international one?
I mean, the issue in terms of ARPU globally has been India, which is where it has, about, if not more than a third of its customer base charges almost nothing. In the U.S., I don't think that's a huge issue, in large part because it's raising prices, as it announced today. The current price that people pay for Disney Plus is going to be what they have to start paying with ads. Hulu, the prices are going up. I mean, the thing that really Disney announced today is not only stronger growth than anybody expected in streaming, which kind of bucks the trend we saw everywhere else, whether it was Netflix, HBO Max, Paramount, Peacock, but perhaps most importantly, that it's raising prices across the board for all of its services, and it feels like it's now, established itself enough with the customers that it's able to do that. That should boost ARPU, that should boost profitability, and the real question is whether that will put a drag on subscriber growth going forward.
Because what is it? Average revenue per user is about $4 for Disney Plus, and they're going to be raising the ad-free subscription price to an $11, which still seems incredibly affordable in many ways. Did we know that they were going to have this free but with advertising streaming product as well? Is that relatively new, or is that something that we anticipated given Netflix?
They had previously announced, or at least there had been several reports that there would be an ad-supported service. I think that came out actually before Netflix said what they were going to do, and they've talked in their upfront communications, which is sort of the ad selling period, about having some success in that area. Disney obviously has a lot more experience selling ads in high-end video than Netflix does, and Hulu is already one of the largest players in terms of ad-supported paid video.
Hey, Lucas, I want to ask you too about the media side of the business. ABC, ESPN networks, profit there up 13% to $2.47 billion. They talked about higher ad revenue and fees from cable distributors and other. I think we were a little concerned about ESPN not getting the Big Ten TV rights. Sounds like media is doing okay.
Yeah, I mean, look, it's not the fast-growing part of the business. It's not like they're adding tens of millions of subscribers a year. But ESPN is relatively well-positioned compared to some of its peers just because ESPN, for all of its kind of macro problems, is still one of the main reasons that people pay for cable. It's certainly one of the reasons that I still pay for still pay for a pay TV service because I want to be able to watch sports. You bring up the Big Ten. Yes, them losing Big Ten is a problem. They are gaining the SEC, which is, arguably a more popular football conference in a couple of years. I don't think anybody's worried about the rights that ESPN has or what the product that Disney has that it can offer to people on cable. The issue there longer term is sort of cost relative to revenue. The number of people paying for TV is still going down and their costs are going way up in terms of the rights that they have to pay and for sports and the cost of production for film and TV.
Still waiting for them to put dressage on TV. I don't have to worry about that. But Lucas, I want to compare and contrast what we learned from the social media companies to what we're learning about some of the streaming businesses. When you think back to Meta, when you think back to Snap, having trouble with ad sales and that really showing up in results. Obviously, that doesn't seem to be a problem for Disney, but as they introduce this ad-supported sort of model, is there any concern there that they'll have trouble selling those spots?
Well, one of the things to keep in mind in the ad business is that a lot of the digital ad business is, it's transacted upon daily. So you're constantly adjusting your campaigns and your spend and what you're buying. A lot of it, at least on Meta or Facebook, is smaller businesses buying. TV is big brand advertisers, awareness. Those deals are often done months in advance. Yes, there's what's called a scatter market, which is sort of filling in the holes as you go. But a lot of the deals are done in that upfront marketplace, which is why you may not see the same immediate impact when there's some pullback. The other thing is that TV hasn't been growing at the same rate as some of those tech companies. Tech had been putting up 10, 20, 30, even 40 or 50% growth in some quarters. Most of the TV business is sort of peaked and it's managing decline or shifting some of that to the internet. And so you won't see as dramatic an impact on them, at least we haven't so far. There is a possibility that they'll struggle to fill some of the inventory, but I think some of the real estate in Netflix and Disney Plus is so choice that they won't have a hard time, especially because they'll start off with almost no customers. So there won't be that much inventory.
Really appreciate your insights. Our very own Lucas Shaw. Carol, as we digest further CEO statements, continuing to talk about an excellent quarter, live sports, theme parks, subscriber growth, you name it.
Yeah, it's good to be a Disney executive with a report like this right now. Shares of Disney up almost 6% in the aftermarket. Want to head over to Ken Leon. He is CFRA Director of Equity Research. So, Ken, it really is about that Disney Plus subscriber beat, also that price hike and the ad-free streaming price. How do you see the quarter?
They had solid results, mostly from linear networks. So programming, entertainment was strong. Subscribers, you got to be careful because it was a good jump in the total, but a significant amount of that came from Disney Plus Hotstar, which is India, which is very small monthly rate plans, 76 cents a month versus their other plans, which are over $6. So I'm not so much focused on the subscriber count, but the operating losses also for direct to consumer increased sequentially from the April quarter to $1 billion. So there's more work to be done on Disney Plus. What's interesting in the linear networks is that they were able to ratchet down programming costs, which made it more profitable. So this was a really strong quarter, mostly from the traditional established businesses. But we think there's going to be, as we all go through the detailed releases, still some issues with Disney Plus.
Ken, what do you think of this notion of running both a subscription streaming service and an ad-supported streaming service? Is it a good idea? Do you think something that would be emulated by some of the other streaming companies out there?
Yeah, so Disney's is probably like the sixth media company, and the question's going to come up on the earnings call at 4:30. And especially with the offering they have with content and distribution, absolutely, they need to go to AVOD. It also captures another part of the market on demographics, especially as we look possibly at recession in 2023.
I like the way that you're getting under the hood for us, really telling us some of the areas to be concerned for. What many had wanted to know, and I'm sure they'll be asking me on the call, Bob Chapek, is are you standing by your 2024 guidance, in particular for Disney Plus? Are you still seeing up to 260 million subscribers for Disney Plus alone? Are you anticipating him to dial that back a bit, Ken?
Yeah, I love the question. So, it's 230 to 260 million subs. I'm not so sure subscriber growth really matters here. David Zaslav, for Warner Brothers Discovery said it's all about getting to positive EBITDA, profitability, and also a lot of this is going to be driven on the quality of the subscribers. Yeah. So I'm not sure that number really matters, and it's almost looking back to where the streaming market was maybe 3-6 months ago. I think we're in a very different environment, and one where shareholders want to make money and get returns.
How about the company in terms of passing on a lot of those costs to the consumer? A company that firmly reminds us of pricing power, Ken, when you think of Porter's 5 Forces, that's got to be a key one.
It is, but when you think of Disney, how do they fire on all cylinders? So the parks is still part of the recovery, and that's reflected in the numbers here. But then again, we go into the softer rest of this year. You need obviously blockbuster movies. They didn't have a Top Gun Maverick, but they will have major movies coming out for releases as we get closer to the holiday season, such as Star Wars and others. So that was not there. But really, to blow it out of the park for Disney, you need all these areas to really be at the top of their game. And at the same time, you have the drag where you have $1 billion quarterly loss on Disney Plus, and they're going to steer through that important question of, is it 260 million subs that makes it great, or is it how do you manage it effectively? 37% of those Disney Plus customers come from India again. And I want to emphasize that because they generate only $40 or $50 million of revenue.
Ken, I want to talk about what's happening in the after hours right now, because you have Disney shares 6% higher or so, and we're talking about a stock that's on track for its worst year since 2008, down over 20%, 27% rather, to today's close. And I'm curious whether the news that we heard after the bell is good enough, basically, to justify what we're seeing right now.
So it may not be the results or the fundamental commentary I have, but it might be because sentiment for this area, this industry, and also Disney was so negative. So I think this is almost a relief rally for Disney shares, and it really speaks to a stock that has come down significantly in the last 12 months, but one that obviously has great franchise across all these businesses, but still has some execution risk, trying to pivot a little bit into streaming, perhaps with recession.
All right, we're going to leave it there on that note. Ken Leon over at CFRA, Director of Equity Research. So obviously focusing on Disney, the stock is definitely rallying about 5-6% here in the after hours. Big outperformance when it comes to Disney Plus. But guys, I do wonder, Ken bringing up a good point. I mean, this is a stock that's still under pressure for the year. It's down about 27% here. So there's still lots of questions, Mike, when it comes to, will consumers continue to go to the park and really tap into all that Disney has to offer?
Yeah, and I think that's a really important thing to discuss today is all that Disney has to offer. When I think of Disney, not only on ABC, ESPN, one of the biggest sellers of advertisements, but also they're one of the biggest buyers of advertisements. So, Katie, wondering if we're going to tune into this Disney ad-supported service and see a lot of ads for, Disney. Might make the most sense.
That might make sense. Yeah, that would be very circular in nature. It's interesting to see the lack of ripple effect this is having on some of the competitors right now, this huge surge that we're seeing after hours in Disney. You look at the likes of Netflix, it's a touch lower, down 0.3%, but it doesn't seem too fussed.
I just think of a company that has really built a moat around it. I think as Geetha was saying, the timing is spectacular for this company. Caroline, when we were thinking about Netflix and going to more of an ad-supported model versus a subscription, most of the analysts had said, why haven't they done that already? And you just think about the timing, the execution that Disney has huge standout for me.
Yeah, still a $205 billion company. If you put it into the market capitalization, it's come down a lot, but still a company that's able to drive that sort of 20% revenue growth. You don't usually see that from these sorts of sizes of business. They're able to weather, of course, a COVID storm by having the streaming product at the same time as you have the parks. And now with hopefully COVID-19 in the back mirror, we now start to depend more on the going out into the real world, Carol.
All right, I'm looking at S&P 500 mini futures in the after hours up 2%. So it was a day with a lot of positive news. So we'll see, Caroline, whether it continues into tomorrow's trade.
I wonder how it affects an 8.5% inflation reading if we're going to say a 38% increase in the base price of Disney Plus. That does it for our cross-platform
we get a commercial
coverage.
break.
Yeah, we do finally. The market closed. We waved goodbye to it. Bloomberg TV, radio, and YouTube. But we're back tomorrow at the same time, same place. Triple Take is next. There's a Bloomberg.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody, this is Bloomberg Business Week. Carol Masser, Michael Regan is in for Tim Stenovic on this Wednesday, watching those Disney shares still up about 6% in the after hours. Covering all of that in the after hours news, we're back over to Charlie Pellet with the Bloomberg Business News Flash. Hey, Charlie.
Thank you very much. Lots going on. Big report out of the Walt Disney Company. Profit topped estimates. Disney raising the price of its flagship Disney Plus streaming service by 38%, all part of a plan to generate more revenue for its money-losing online businesses and build on third quarter results that beat estimates for sales, profit, and subscriber growth. Geetha Raghunathan is a media analyst with Bloomberg Intelligence. She was our guest right here on Bloomberg Business Week.
Oh, yeah, this is a blowout quarter. We were looking at something like 9.8, 10 million subscriber ads. They come out with 14.4 million. And it's not just the subscriber number. It's all across the businesses. You look at that parks number, we were expecting about 1.7 billion in operating profit. I think it's close to about 2.2 billion.
And after hours, Walt Disney Company shares up by 5.7%. Equity staged a major rally today, a CPI Wednesday propelled by tech shares as traders read cooling inflation data as a sign the Fed may curb the pace of interest rate hikes. Alan Lance is director of research at lanceglobal.com, and he was our guest right here on Bloomberg Business Week.
All of a sudden now, one CPI report and now inflation is calm and taken care of, et cetera. So for some reason, investors, meme stocks are back, and it's just a total exaggeration.
S&P up 87 points today, up 2.1%. The Dow rallied 535, up 1.6%. NASDAQ up 360 points today. For NASDAQ, that was a gain of 2.9%. 10-year yield, 2.78%. Two-year yield, 3.22%. Spot gold down $2.50 the ounce, down by about 0.1%, $17.91 the ounce on spot gold, while West Texas Intermediate crude up at $91.59 a barrel, a gain today of 1.9%. So again, recapping, a Disney beat, shares surging 5.7% after hours. Big rally on Wall Street with the Dow, the S&P, and NASDAQ all advancing. S&P today up by 2.1%. Lots going on. I'm Charlie Pellet. That is a Bloomberg Business Flash.
And you have it all covered, as you always do. All right, Charlie Pellet, thank you so much. So our next guest we talked with back in June. So much has happened, including this past weekend of U.S. Senate passage of a key tax, climate, and healthcare bill. A lot of money and initiatives going into the alternative energy space. It's a group that we've seen on the equity side of things certainly rally. Let's get some thoughts on that and the company's earnings, which were reported after last night's close. We're talking about Plug Power. Andy Marsh is president and CEO of the company, and he joins us on the phone from Latham, New York. Andy, nice to have you back with us. How are you?
I'm quite happy today, Carol. It was a good day for the company. It's been a good couple of weeks.
Well, I have to say, shares of Plug Power have rallied more than 100% since May 11th. Tell us about the good news and what you're seeing in terms of business momentum at the company and the outlook.
Carol, I think the market was excited about Plug for a few reasons. We have an electrolyzer business which takes green electricity to produce green hydrogen. Before even the announcements of the production tax credit for green hydrogen, we have seen bookings 50% higher for the year than we expected for the whole year. We've done 1.5 gigawatts. That excited the market. I think the second item that excited the market is that our path to $3 billion in 2025 and 17% OI, even becomes brighter when you include the production tax credit that was passed. And I think on top of that, we were able to reiterate guidance for this year. And I think that made investors comfortable with the direction the company's taken.
Andy, I'm wondering, is there any visibility on when you think Plug Power will turn to profitability, either on a quarterly, annual basis, next few years, or any sense on that?
Sure. Our CFO yesterday was very clear in pronouncing that the company would be profitable in 2024.
So two more years, okay. And that's on a net income basis?
That's not 2 years, Mike. It's August. That's like 17 months.
Well, what's it take to get there? What is it? Just a matter of reducing R&D and that sort of thing, and seeing some of these projects just start to bring in the revenue?
Oh, I would never reduce R&D. This industry is just starting, Mike.
Yeah.
Where it's coming from is the build out of our green hydrogen network across the United States. We have first mover advantage. We'll have 500 tons deployed per day by 2025 in the States, 70 tons by the end of this year. It dramatically impacts our cost of fuel, which really is one of the big items in keeping us from being profitable. And we're becoming vertically integrated to make sure that we're providing it to ourselves cost effectively. And that's really one of the big items that changes our income statement.
Where is it, though, in terms of, we're still such a fossil fuel economy globally, but we did talk with one of our colleagues out of London earlier, who is currently an energy products reporter, but we said, is it just in 5 years that your title is going to have to change because we're not so fossily or not so, reliant on fossil fuels? How do you, in terms of hydrogen and how much does it continue to be a part of our energy society?
Hydrogen ultimately, and Carol, these are not my numbers. These are numbers like your organization, Bloomberg, that thinks it will be 20% of world's energy by 2050, and it's growing from now. If you take a look at Walmart, where we announced a 30 tons per day green hydrogen agreement with them, that is helping them on their path to reduce their carbon footprint by 1 gigaton. So the real work is happening now, and certainly the bill that Senator Schumer and Senator Manchin were instrumental in having passed will just accelerate this move in the world to a green economy.
Yeah, Andy, I wanted to ask you about that. How does hydrogen in general and Plug Power specifically sort of fit into this Inflation Reduction Act, which has so many perks for green energy? And on top of that, is there a risk, in the midterms of some of that being undone?
Well, I think that I'm going to answer your last question first. When there was an investment tax credit for fuel cells, actually, the House bill had more Republican co-signers than Democrat co-signers. I've met with people like Senator Cassidy from Louisiana. They are strong supporters of hydrogen. This act that, it's obviously Senator Schumer and Manchin, who are both huge supporters, has a $3 production tax credit for green hydrogen, which makes hydrogen from green sources competitive with any other form of hydrogen. It's a big deal because the market for hydrogen is large today from natural gas. Now we're lower cost and competitive with natural gas hydrogen today. It helps our electrolyzer business. It helps our fuel cell business because it'll be able to drive all sorts of applications like the backup power system we developed for Microsoft, which makes fuel cost effective with today's diesel.
And green hydrogen, I mean, just remind everybody you're using it, but this is hydrogen power that's generated by renewables, right? Whether it's wind, whether it's solar.
Or hydropower. I mean, one of my favorite plants is the one we're building in New York. And just like George Westinghouse built the first electrical network using Niagara Falls power, we're using Niagara Falls power to create green hydrogen.
What is the biggest thing that's holding back green hydrogen right now?
Well, I think the biggest, I think what the Senate has done and what the House will do probably by the end of the week will be the big accelerator for this market. And I think they put us in a position where green hydrogen will now be cost competitive. And it's our responsibility to make sure that we leverage this time like they did in solar and wind so that the cost of green hydrogen will always be lower with or without government support in the long run.
Andy, it's interesting. In addition to the top line and bottom line of your company, which is obviously very important, but we've also got a planet to consider here. And I'm wondering, how optimistic are you about everything that's been done by Congress and about the future of the hydrogen power industry to really help save the world, help reduce this climate damage that is really starting to come to roost now with all these weather anomalies and everything? Is there reason to be optimistic about the climate going forward, given all these developments this year?
Absolutely, Mike. Let me tell you, I worked in wireless in 1983 when nobody knew what wireless was. And I've seen creation of industries. And this bill by Congress is good for the national security of the United States. It's good for climate change. It's good for creating jobs. And it will create momentum with customers like Amazon who want to be carbon, or looking to be carbon neutral by 2040. It's good for customers like Microsoft, which want to eliminate diesel from their process. This bill will help make it happen, and it actually puts the United States in a unique leadership position. So I think the kids running around in 2050 are going to be really happy with what the Senate did in 2022.
Andy, just quickly, just got about 30 seconds. Are we seeing the industrial demand for green hydrogen, which will be crucial in really helping it take off? Just quickly.
Absolutely. I think you may have seen our deal with New Fortress Energy. We're actually, many fertilizer plants are looking to move to green hydrogen. That is really the big opportunity, that and green steel, and we see it happening.
All right. Always fun to talk with you and get this update, especially in an important week in terms of legislation and a bill coming out of Congress moving towards more climate energy initiatives. We got to run. Andy, thank you so much. Andy Marsh, President and CEO of Plug Power, joining us on the phone from New York State. All right, let's get back to world and national news and to Nancy Lyons. Hey, Nance.
Thanks, Carol. Former President Donald Trump invoked the Fifth Amendment today in the New York Attorney General's long-running investigation into his business. Bloomberg's Nathan Hager with the latest.
The former president arrived at Letitia James's office this morning to give a deposition. Afterward, he issued a statement saying he declined to answer questions under the advice of his counsel. The New York AG has been investigating for months whether the Trump organization manipulated asset valuations to score tax breaks and better terms on bank loans and insurance. Former President Trump says he once asked, if you're innocent, why would you plead the Fifth Amendment? Now he says he knows the answer to that question. In Washington, I'm Nathan Hager, Bloomberg Radio.
U.S. inflation decelerated in July by more than expected, reflecting lower energy prices, which may take some pressure off the Fed to continue aggressively hiking interest rates. President Biden says the economy may be turning a corner.
We're seeing a stronger labor market where jobs are booming and Americans are working, and we're seeing some signs that inflation may be beginning to moderate. That's what happens when you build an economy from the bottom up and the middle out.
President Biden says there could still be some headwinds in the months ahead due to the invasion of Ukraine, as well as disruptions in the supply chain due to pandemic closures in Asia. Biden spoke on inflation at the signing event for a veterans bill that expands benefits to those who were exposed to toxic burn pits. The president believes his own son, Beau, who served in the Army National Guard, died of cancer caused by exposure to those burn pits. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nancy Lyons, thank you so much. Nancy Lyons in our DC newsroom. Just want to remind everybody, watching Disney in the aftermarket, stock still up more than 5% this after the company tops profit views, raises its ad-free streaming price, and really it's Disney Plus subscribers, an outperformance, 152.1 million subscribers overall. The estimate was 148.4, so This is a stock we'll continue to probably see trade higher into the Thursday trade. In the meantime, we want to talk a little bit about hedge funds because SEC, they're kind of on their radar.
Yeah. Expansion of confidential filings that big managers must file quarterly with the SEC would mark one of the biggest increases in regulation for the private fund industry in a decade. Basically, they just have to start giving the government a lot more information about their investment strategies, which I have to say, Carol, as a financial reporter, I'm kind of chomping at the bit to see how this plays out.
Isn't that their secret sauce? Isn't that something, their algorithms, their strategy, like they always keep under wraps?
Yeah, and it sounds like we, in the general public, we won't necessarily get to see them. But who knows? Maybe that's next.
So I guess you see it so that regulators can see it and say, well, wait a minute, this maybe could put the financial system at risk.
Right. Or this is potentially manipulative. This is what caused this problem or that problem last quarter, and just they'll have a better sense of where to go to put out any fires that they need to put out, or at least I guess that's the theory.
I have to say, when we were at Milken this year, we were just blown away by how much the conversation revolved around the private markets, whether it's private equity, whether it's hedge funds versus the public markets. And I do wonder, how much then maybe do they need transparency about private equity moves?
Well, right, and I think that explains a lot of the appeal of those markets is a little bit less scrutiny on them. And
right?
Family offices, I wonder, so many hedge funds have converted to family offices that have less hoops to jump through, so maybe this will be more of that.
We shall certainly stay tuned on that one. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Shares of the Walt Disney Company up now by about 5% after the bell. A big Disney beat. The conference call underway right now. Profit topped estimates. Disney raising the price of its flagship Disney Plus streaming service by 38%, all part of a plan to generate more revenue for its money-losing online businesses and build on third-quarter results that beat estimates for sales, profit, and subscriber growth. Big day for the U.S. stock market today. A rally for the Dow, the S&P, and NASDAQ. We closed at or near session highs. The Dow up 535, up 1.6%. CPI Wednesday, the S&P up 87, up 2.1%. NASDAQ up 360, a gain of 2.9%. Tech stocks led the way higher as traders read cooling inflation data as a sign that the Fed may curb the pace of interest rate increases. 10-year yield 2.78%, 2-year yield 3.21%. Spot gold down $2 the ounce to $17.91. That was a drop today of 0.1%. West Texas Intermediate crude up 1.3%. WTI 91.66 a barrel. So again, recapping an after-hours Disney rally, S&P today advanced 87 points, up 2.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Another busy day. All right, Charlie, thank you so much. Well, Meritas is a company and app founded by two Wall Street veterans. The aim to democratize Wall Street recruiting and more. The platform simulates the experience of working at a fast-paced hedge fund on your mobile device. At least that's what the company's website says. So we want to find out more. We welcome Neil Dada, Chief Executive Officer at Meritas, joining us via Zoom in New York City. Neil, good to have you here. Tell us a little bit about your company and what you guys do.
Hi, Carol and Mike. Thank you for having me. So my background is I've been an institutional allocator to hedge funds for the last 15 years, really having exposure to some of the most well-known, best-performing hedge fund managers in the space. And over the course of that time, it became abundantly obvious that the folks that are in the position of making investment decisions and managing money for folks that are, whether they're firemen or police officers or institutional investors like myself, it's not necessarily the people that have the most talent, but a lot of times it's the folks that had the best resumes and found themselves in the position to manage that capital. And really what we wanted to do with Meritas was to kind of create a platform that democratizes this access that forever has been limited to folks who have specific resumes, came to specific schools. So that's the platform in a nutshell. And really what we do is we extend this access to folks regardless of their ability to finance their trading or their actual education. So it's a free app that you download that allows you to simulate working at a hedge fund and trading equities and crypto, and your experience generates an alpha score. And we take that alpha score and we allow you to apply for jobs on Wall Street with that score. So it's really bringing that experience to everyone through their mobile devices.
It's almost like the journalism test we have to take to get into Bloomberg, right? But you do it for hedge funds. Like, it gives you a chance to kind of play a little bit, right? And get a score so people can evaluate you.
Yeah, exactly. And one thing that was kind of really obvious to me was that I've been managing large pools of capital, and my co-founder Gabriel as well, and we realized that even at the scale and scope that we invest, even ourselves, we don't actually own our own track record. And it's a rare thing to be able to own your own alpha, to own your investment experience. And this is what we think we should do to everyone and give everyone the opportunity to, whether you're a junior analyst at a bank and you want to leverage your experience, most of the time your employer owns your actual ideas. And we give folks like that an ability to say, hey, this is why I'm talented, and this is why you should hire me based upon my talent, not what based on my resume says.
It's pretty fascinating stuff, Neil. So let me make sure I'm picturing this right. So I log in and I basically can start doing some paper trading, and you'll be able to track my P&L and sort of rank me among other traders. What happens if, say, my strategy is some algorithm, fast twitch type of thing? Am I able to sort of input a automated strategy into this thing as well?
That's a great question, and the answer is no, actually. And we take the view that, being allocators into these strategies, so I know the folks that you can think of that are kind of at the forefront of high frequency and systematic trading, we take the view that it's very difficult for a typical person to compete against a big $10 billion hedge fund. So really, we're meant for fundamental investing. We're meant for people that do, research on individual companies and take views on things like market share and earnings and growth potential. We're not focused on kind of day trading or systematic trading, because the thinking is that that's not a game that a typical person can succeed at.
It's interesting. We just talked, Neil, Mike, and myself about how hedge funds are pushing the SEC, or the SEC, excuse me, is pushing hedge funds to share more of their strategies, essentially make them more transparent. In general, just creating more transparency within the hedge fund industry, that would be a good thing in terms of individual performances, those who work there, and just kind of understanding a little bit more of what goes on behind the scenes.
Sure, it's a great point. Transparency is almost always a good thing. The only way I would caveat that is if you go back a year and a half to, the meme stock rally in GameStop, something that was kind of the byproduct of that was folks that were involved in those trades, they just made the decision that they're not going to do those trades publicly anymore. So there's ways to express shorts on companies that you expect to fall, but you do it synthetically, so it's what's called staying off the tape. So it's not hitting 13F filings, 13G filings. And this was actually the source of the information that the folks on Reddit used to, attack certain hedge funds. So really, I think what it did was it forced these managers to kind of circumvent the public reporting that, theoretically is in everyone's best interest.
Yeah, so Neil, I'm wondering how Meritas makes money off of this. It is a free app. I'm guessing the users, the traders get to use it for free, and then maybe the hedge funds pay for access to see who's doing what?
Yeah, exactly. So we're effectively a recruiting platform. So the way I like to think of us is we're kind of like the NCAA for Wall Street, where you join our platform, you showcase your skills, and if your skills happen to match an employer who finds that valuable, then they'll reach out to you directly, and then we'll get paid on the recruiting fee that the employer will pay us.
Hey, Neil, how does this maybe help create more diversity when it comes to financial firms, hedge funds specifically? Because that is certainly something we've talked about a lot over the last couple of years. And while there's progress being made, there's a long way to go. So how might what you guys are doing help with that? Can you make it kind of colorblind, sex blind, like can you, or gender blind? Can you do that so that we maybe up the diversity ante?
Sure, great question. And if you think of the way recruiting is done at hedge funds and big banks, it really hasn't changed in the last 100 years. It's effectively a network of who you know and how well you're connected, and those are the metrics that typically place people, particularly in most highest income roles like portfolio manager and analyst. So we take the view that it should be a democratized system that should be based solely on your talent. So through us, we don't care what you look like. We don't care what your resume says. We don't even care where you went to school. Right. We only care about your ideas, and those ideas can potentially get you paid or get you recruited. So it actually does level the playing field. And what I think about is, whether you're, as we've heard many times, certain folks are steered towards sales and marketing roles, right, and certain folks are steered towards portfolio management roles. If you're a marketing associate and you happen to have great trading ideas, you can prove you have ideas and then leverage that into your next role.
All right, next time you come on, though, we're going to find out about the custom score that you got generated. I'm assuming you did a test, and we'd love to hear. Keep us, stay in touch. Let us know how this is going. Neil Data, he's Chief Executive Officer at Meritas, joining us via Zoom in New York City. That's going to do it for the Wednesday trade. Big CPI print and a big Disney number. That stock's still up 5%. For Mike Regan, I'm Carol Massar. Have a great evening.
Okay, guys. Hope you enjoyed our sessions. I will have a break for 1 week, so I will see you all next week on Friday. So have a break. I'll see you all from 8 o'clock, as always, UK time, 8 o'clock in the morning. Have a great weekend. Have a great holiday, and I'll speak to you soon.
From the heart of where innovation